If you're looking to buy or refinance a home and you've been turned down because your tax returns show insufficient earnings, then you know how difficult it can be for the self-employed to get some shelter. But what if I told you that it may be possible to use your bank statements instead of your tax returns to demonstrate that you really do have an ability to repay your mortgage? Sound like a bank statement loan might be a fit for you too? Let's start it up right now. Hey guys, welcome to Rockin' Real Estate. I'm Rob Spinoza with Guaranteed Rate. If you're a home buyer, a homeowner, or even a real estate professional looking for home finance tips, tricks, and the occasional cool guitar licks, I've got your backstage pass to a better understanding of the mortgage business. Before we begin, let me start by saying that I understand that it can be very stressful to get a mortgage if you don't fit into the traditional income documentation box. So if you're a self-employed business owner, a retiree, or you have your own unique situation, and you find yourself stuck and don't have time to watch the full video, just get in touch at 415-367-5959 and we'll be happy to advise. Okay, when we talk about qualifying for a mortgage, we have to first discuss the concept of ability to repay, or ATR. In our industry's eyes, there are guidelines that define what documentation consumers need to show in order to demonstrate ability to repay. And you guessed it, these fall closely in line with what you would expect: W-2s, pay stubs, tax returns, and so on. But if your income, for one reason or another, is not realistically represented on that sort of documentation, you can easily find yourself out of luck, even if you know you can afford the mortgage you seek. Let's take the most common example, a self-employed business owner. When this person goes to file his or her taxes, the objective is to file all of the relevant deductions and reduce taxable income as much as possible. But then when this same person goes to get a mortgage, the lender wants to see the exact opposite. That is, the income as high as possible so as to provide the best ability to repay. And it's often impossible for this borrower to meet both objectives at the same time. With a bank statement loan, on the other hand, the lender will not look at your taxes. That's right, tax returns are not required. Instead, the income for qualification will be derived by either 12 or 24 months of business bank statements. Yes, sometimes personal bank statements will be allowed too, but for now, let's stick with business bank statements. A lender qualifying a bank statement loan will review all of the business income and deposits and will apply an expense ratio to the average monthly deposit amount. That resulting number will be the monthly qualifying income. Simple as that. Let's say that over a 24-month period, the business averages $10,000 per month in deposits, and we apply a 30% expense ratio. This borrower would have $7,000 per month in qualifying income on a bank statement program. Because bank statement loans are considered non-qualifying or non-QM mortgages, it's reasonable to expect that the rate might be higher on this type of program than it would be on a traditionally documented one. However, the difference in rate is one that might be acceptable upon closer review and in light of any other alternatives. So if you think a bank statement loan might be a fit for you, or if you have questions about any other aspect of the mortgage process that will get you the financing you need, don't hesitate to get in touch at any of the links below or by calling us directly at 415-367-5959. And if you found today's video helpful, please click on the like and subscribe buttons below and we'll keep the hits coming.